Welcome to this financial modeling training. My name is Williams, and over the next few sessions, we are going to take a very practical journey into how money works inside a business, not just as an accountant, but as someone who drives business decisions. So this is the first lesson we'll be looking at in this financial modeling course. And the lesson is on Introduction to Financial Management. That's lesson 1. Now, let me ask you a simple question first. If you own a business and you make 10 million in sales this month, does that mean your business is doing well? Of course, you will want to say yes. But actually, that depends, because what if your cost of running that business is 11 million? So it means that when you make 10 million in sales and the cost of running that business is 11 million. So you know what that actually means? That simply tells you that you just made 10 million naira and you lost 1 million. Look at it well. So you just made 10 million naira and you lost 1 million. That is what financial management is about. Financial management goes beyond just seeing numbers. Financial management is about understanding what those numbers mean and making smart decisions based on them. So we start from the very foundation when we're looking at financial modeling. We start from the very foundation. And by the time we finish this series, you will be able to read a financial statement. You will be able to actually build financial model in Excel, and you'll be able to advise a business on capital decisions. So to begin with, what is financial management? Now, financial management is the planning, organizing, directing, and controlling of financial activities within an organization. In plain English, what this means is that financial management is the discipline of managing money so that a business can survive, so that a business can grow, so that a business can create value for its owners. There are 3 core objectives of financial management, and I want you to write it down. 3 core objectives. 3 core objectives of financial management. 3 core objectives of financial management. Write it down. The first objective is profit maximization. Profit maximization. Now, profit maximization is making the most profit possible from available resources. So you maximize profits. You're making the most profits possible from available resources. The second core objective of financial management is wealth maximization. Wealth maximization. Wealth maximization is all about increasing the long-term value of the business for shareholders. The third objective is liquidity maximization. Liquidity maximization. In fact, call it liquidity management. Liquidity management. Now, liquidity management is all about ensuring the business always has enough cash to meet its obligations. Now, many students usually confuse financial management with accounting. So I want us to look at the difference. When we look at accounting, first of all, accounting records what has already happened, which is in the past, right? But for financial management uses those records that have already happened, those records that accounting have put together. Financial management uses it to plan, to decide, and control the future. Think of it this way. An accountant is like, the person we call an accountant is like a doctor reading your test results. A financial manager now is like the doctor who now says, based on these results, here is what you should eat. Based on these results, here is what drugs to take. Based on these results, here is what habits you have to change. That's the main distinction between accounting and financial management, as well as an accountant and a financial manager. I hope we understand. Quickly, let us look into the aspect of the three pillars of financial management. 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 Pillar number one is investment decisions. This is what we also refer to as capital budgeting. Now, this first pillar is where should a business put its money. That's majorly what it's about. Anytime you hear about investment decision, even in financial modeling, you're doing it because you're looking at that point, you're concerned with where should this business put its money. Think about a business like Dangote. Should Dangote build a new cement plant? Should a Lagos restaurant open a second branch in Abuja? Should a restaurant in Edo State open a second branch in Abuja? These are investment decisions. Now, as far as investment decision is concerned, there are tools we use. There are key tools we use. Yeah. And the key tools include tools like the net present value, NPV. We also have another tool called the internal rate of return. Internal rate of return, that's IRR. So we are definitely going to cover this in detail in lesson 3. Let's move to the next pillar of financial management. The next pillar of financial management is financing decision. Financing decisions. This is what we refer to as capital structure. Now, this second pillar is all about how should a business fund its activities. How should a business fund its activities? That's what it's about, capital structure. Should the business borrow from a bank? Should the business borrow from a bank? Should the business issue shares? Should the business use retained earnings? So capital structure, financing decision is about finding the right mix of debt and equity. Please take notes. What we call the capital structure is about finding the right mix of debt and equity. In Nigeria today, many SMEs rely too heavily on bank loans at very high interest rates, sometimes 25% to 30% per annum. So what a financial manager needs to do is that a financial manager must evaluate whether that borrowing is worth it. The next is dividend decision. Dividend decisions. Now, for dividend decisions, this is a decision that happens after the business makes profits. So, after the business makes profits, what do we do with it? Do we pay it out to shareholders as dividend, or do we reinvest it back into the business? This decision affects both investor confidence and the growth capacity of the company. I hope we understand. It affects both investor confidence and the growth capacity of the company. Now, I want us to quickly look at a case study, because throughout this lesson series, we will follow one company called Lego Smart Supermarkets Limited. And this is actually a fictional but very realistic medium-sized supermarket based in Ikeja, Lagos. So we'll be using it to just look at this so we have an understanding of what we're actually doing here. Now, this is the background of this company. So I said the case study is about Lego Smart. So it's about Lego Smart Supermarkets Limited. Now take the background. Okay, so this supermarket was founded in 2019 by Chidi Okonkwo. The supermarket sells we are also told that the supermarket sells groceries. It sells household items and electronics. NICS accessories. We're also told that their annual turnover, they have an annual turnover of approximately 480 million naira as at year 2023. And we're also told that the company has 2 branches, Ikeja and Lekki. The company have a staff strength of 45 employees. Now, we're also told the financial mix too, that the financial mix, the finance, okay, we are told that the company is financed through a mix of owners' equity and a 30 million naira bank loan from Access Bank. Now, in every lesson, we will look at Lego Smart's real numbers. We are going to look at their income statements, which I have here. We'll look at their income statements here. We'll look at their balance sheets, the statement of financial position. We'll look at the cash flow statements, and we'll use them to make financial decisions. So by the time we are looking at lesson 4, you will build their entire 3-statement financial model in Excel. I hope this is understood. So before we close this first lesson, I want to ground this in our Nigerian reality. Financial management in Nigeria has unique challenges. One of the first challenges is high inflation, which is currently hovering above 30%, which erodes the real value of money. Another challenge is volatile exchange rates, and that challenge affects businesses that import goods or have dollar-denominated obligations. Another challenge is high cost of credit. CBN policy rates affect bank lending rates significantly. Another challenge is the tax environment. Companies' income tax, the VAT, withholding tax, all impact financial decisions. Foreign exchange restrictions also is a challenge because it affects dividend repatriation for multinationals. So as a good financial manager, what you have to do in Nigeria, you must factor all of this into every decision. And that is exactly what makes this very topic both challenging and extremely valuable. So let us do a quick recap, a quick summary and recap. Today we covered the definition and objectives of financial management, the difference between accounting and financial management. We talked about the 3 pillars: investment, financing, and dividend decisions. We're also looking to introduction to our case study company, which is Lego Smart Supermarket Limited, which, like I said, is the unique Nigerian context. We'll use it to see how we can apply it for this very lesson. So in our next session, we are going deeper into financial statements, specifically how to read and analyze income statements, how to read and analyze the statement of financial position, the balance sheet, how to read and analyze the cash flow statements. So make sure you come with a pen and paper or better still, your Excel open. Before the next class, write down what do you think are the top 3 financial risks facing Lagos Smart supermarkets right now and why? So based on what I've given you here, what do you think are the top 3 financial risks facing Lagos Smart supermarket right now and why? See you in the next lesson on understanding financial statements.